Thanks so much for tuning into Talking Point today. I'm your host, Neeraj Shah. Well, the conversation around IT is never dull. It's never been dull for the last 5, 6 years, if you will. And the last 24 months, for varied reasons and varied cycles, has been very, very active. We were looking at the data of companies that have been caught in the eye of the storm in the last 1 month, ever since the conversation around valuations and other factors peaked up, and holding back of the variable pay also peaked out, so to say. One company which outperformed all of its peers was Happiest Minds. The fact that they clocked in over 9% growth on the revenue side sequentially in quarter 1 did not go unnoticed either. So while we didn't talk to them around their results, it's best to get them in for a slightly longer conversation on how do the two gentlemen who talk to us always see the nuts and bolts of the landscape as it exists right now, and what they have to say about the quarters ahead. Venkatraman, Narayanan, and Joseph Anantharaju joining to talk about that. Gentlemen, both of you, thanks for joining in. A good morning and good evening, respectively, to both of you. Venkat, can we start off with the Q1 performance, though? Different companies had different performances laid out in quarter 1, and the conversation or the hypothesis about what would happen in the quarters ahead was also very, very varied. What are you saying after the very strong performance that you put out in quarter 1?
So good morning, Neeraj, and thanks for giving us this opportunity to give you maybe nuts and bolts of our performance of quarter and maybe an outlook of how we see things panning out to the next 9 months to start with. So like you said, very good performance in terms of top line. In terms of margin, we have now come close to almost the bigger companies, even though we have been saying that our guidance is something between 22 to 24%. We seem to have been beating that number for the last 8 quarters for with good reasons. But we still believe that on the margin front, I would like to stay within the margin bracket of 22 to 24%. So that's on the margin side. So obviously, if you look at the guidance and the performance, there has been an outperformance. As far as revenue growth, we've been consistently showing a decent level of revenue growth, and it's largely been led by the markets of US, Europe, and India for us, along with certain other pockets of strength. The question that has been rattling the market has been what happens when weakness sets into US or Europe, and they are seeing that, which is obviously the macroeconomic factors are showing certain weaknesses, kind of a thing. So the question was, all IT companies, we were put on the floor, if I can use that term, asking how do you guys see yourself different? So we were kind of getting prepared to answer that. So start of the last quarter, or this quarter, what we did is before the call, after the results, the teams, which is the 3 BU heads, met customers, which is obviously something that they have started doing after the COVID pandemic, and travel had been brought to almost a stop. Now, meeting customers, getting a first-hand feeling, they communicated it back to us, the finance guys who put out a number saying that, hey, you know what, we are looking at decent amount of growth. There is strength in the market in pockets where we are working, especially because we are digital. We're not seeing any weakness or any postponement kind of project on projects. So having done the growth that we did in Q1, then we had to take a view of how the next 9 months would be. And as you know, in this call, we put all of that together and said that we are upping our guidance to 25% for the current year. And we are also making sure that we would like to grow at a similar number for the next 5 years, so that we can reach that aspirational number of $1 billion in 10 years by 2031. So these two statements were made. One is upping the guidance, which I think was taken positively by the market. Second is the logic for why we did that. Like I briefly explained, but Joseph, being in touch with customers' markets, will be able to give you a lot more better view and handle on that. The third thing is, we also took away the differentiation. Earlier, we did say that we will grow at 20% organically year over year. But right now, what we said is we took that out, that organic part, and we said we'll do 25% growth. Because markets were not kind of understanding, if you do 20%, how do you reach $1 billion? Then, I had to say that there would be certain acquisitions which would also then grow, and that's how we reached $1 billion. So then I think the analyst community and the investor community came back and said, divvying up growth into parts like this maybe a little confusing. So what's that you guys want to grow at? So then that's when we went back to the drawing board, having done the 30+% in the first quarter, the confidence of what we will do in the future. We put our neck out and said we'll do 25% growth this year. But the caveat being, I don't have any opportunity of acquisition, or at least I've not notified the markets immediately of anything. So effectively, the next 9 months growth that has to come will come organically. So it's a 25% organic growth is what we are gunning for, and that's where we are headed. All this has gone maybe positively, has come as a breath of fresh air, amongst obviously the supply chain challenges and all of that, amongst the investor community and the shareholders, and which is what you have seen as a market. So I think I've given you an overview. Now, Joseph will be able to add a lot more of meat around that.
Yeah, I'd like to take part credit for this change in guidance, because if you remember, Venkat, 2 quarters ago, at the last question, we complained to you that, why is it that you are undershooting what you guys do? I had mentioned that, okay, we'll take on board some of that as well. I'm just kidding.
I know. No, I know. You did say that, and which is what one of the inputs that we took back, saying that, yes, analysts are pushing back. People who follow us, track us closely are asking the same. So maybe we need to put out a more, I think, a computed number with the kind of comfort. Back to you guys.
Thank you. Very modest of you to give me part credit as well for that, Joseph. Can I come to you? The 1 or 2 non-nifty IT companies made this point in the quarterly interactions that the recession playbook, if we indeed presume that, let's assume that the Western world would be in a recessionary scenario, but the recession playbook would be different this time than the previous ones, because clients are saying that, hey, we're in the middle of the digitalization process. Even if we want to, we can't stop. Now, my question to you is, you guys are all digital. So tell us, what are customers telling you when it comes to client spends, not just for FY23, but say the next 2 or 3 years?
So, I think if you take out the scenario of a total meltdown or something along the lines of what happened in 2008, by and large, the point that you made of customers not being able to really shut down initiatives is true, because I think the pandemic has really shown customers or companies the need for digital initiatives. The ability to be able to reach their customers anywhere, anytime is extremely important. The need to use analytics and data and get more insights out of the data that they collect is more important than ever. And the customer experience part, ensuring that you meet your customers' expectation and also at the same time engage with them is also very important. So all of these initiatives are underway, and companies if they have to, will find money. As of now, we don't see too much of a stress from a demand standpoint, and I think while we look at inflationary pressure and some stress from a growth perspective, I don't think we're still in a recession. That's what we see. Just given the way consumer and business spend is happening, I don't think we're in a recession. But people more qualified than us, the economists and others, will have to make a determination. But from a investment and spend perspective, we're not there, right? And I would agree that the digital initiatives that customers have started will have to be taken to the logical conclusion. What we are seeing is customers being a little bit more cautious than they were last year, right? Keeping a close eye on what's happening, so that they're prepared if they need to make a move, and also prioritization of various initiatives and projects that they've started. They're looking at what are the initiatives that touch our customers the most, what will give us most bang for the buck. They're looking at these criteria and prioritizing their projects, thinking that the others could happen later. And if there is bigger recession than than they could manage, then they can always sort of put those projects on hold. But so far, barring your seasonal trends in terms of spend, or individual companies that have not met their goals, or have had issues in how they've run the initiatives, seeing some movement in spend. Otherwise, we've not seen a broad change in the demand environment, Neeraj.
So, Joseph, suffice to say that if I've summarized what you're trying to say, that the near term actually looks predictably strong, except for one-off cases. Maybe FY24 or 2023 could be a different kettle of fish, depending on how the Western world unfolds.
In a way, yes. And I think even, FY24, see, because some of these initiatives are 1-2 year initiatives or 3 year initiatives, right? So we'll have to see. And that's why it depends on how, to what extent the economy gets impacted, whether it's deep or whether it's shallow or doesn't get impacted. I think it all depends on that. But, as long as it's not something too deep, I think companies will have to continue their initiatives and take them to a logical conclusion. Otherwise, there's competitive pressure, and they're each one is looking at the other one and saying, "Hey, who'll get ahead of me and complete these initiatives?" So it won't be easy for them. Yeah.
Okay. One more follow-up, Joseph, and then I'll also get Venkat's view on the same. But here's the thing, right? While the Fed is sounding hawkish, if you look at all the financial indicators that happen in around this system, the spreads or etc., they're not really showing the reaction that a normal Fed commentary would. And therefore, my question is, if the Western world escapes a hard landing, all right, even if it's not a very soft landing, but it escapes a hard landing, could there be a scenario that some demand, which has been very cautious for now, might even come back in a hurry in 2023 FY24? Could that happen, or is it too wishful thinking?
No, I think there is some merit to what you're mentioning, Neeraj. The prioritization and what I mentioned, where people are looking a little in some industries or in some functions where they're being a little cautious, that could come back. There are three other factors at play out here, right? One is, if you just look at the past, whenever we've had a recession or the US and Western economies getting impacted, it has, because of the cost pressure and the need to still get things done, it has actually helped offshoring. Maybe a quarter or so is when you get it impacted, and then you'll see the bump up, or maybe 2 quarters if you just go back to 2000, 2001. So that's one thing. I think the same thing will happen, because you still have supply side pressure in especially in US and in Europe also, right? So if there is an increase in demand, or even if it continue at the current level, they have to find some way to get things done. The other thing we are seeing is that many of the companies, they while they know that they have to get initiatives done, they don't want to make long-term commitments in terms of hiring FTEs. So we're seeing quite a few companies putting a freeze on FTE hiring, but giving a little bit more latitude on how to get the projects or programs to completion. And there, they're looking at how do you bring in partners, contractors, vendors to help out. So that could be another area where we may see a bump to the Indian IT industry.
Got it. Venkat, any quick follow-up thoughts there?
Yeah. So just taking off from where Joseph's left, 2001, 2008, COVID, all of these instances, the first industry to actually perk up from a US weakness was the Indian IT industry. So I'm going to stick my neck out and say that if there is an impact on account of a recession that we're seeing, the first to pick up would again be the IT industry. Second is the inflationary scenario. Fed is trying to bring that under control, trying to bring back money into the country, making good all the liquidity that they created during the last 1.5 or 2 years. Has led to an inflationary scenario which has not been seen before. So I think recession with an inflation which is almost like India numbers makes US makes offshoring a story which need not be sold anymore. See, you typically the wage increase that Joseph would have talked about is about 2%, 1.5%, 3%. That's what the IT industry, whether it's our people in the US or the locals have been talking about. Now you're talking about 10%. And as a geography, the employee-employer engagement is also in a form where if there is a change on the cost side, the first thing that they do is give me a raise. I think as a culture, India does not go and ask for a raise. We actually vote with our feet is what they say, right? So similar to that, attrition does show up, but one doesn't ask for an immediate adjustments for inflationary cost impact. And when that happens at the US level, the first thing that comes to the mind in US in terms of the cost is to offshore. Offshore as a story has been sold enough. I don't think it needs to be sold anymore. On top of that, digital is now has to be done kind of a thing. So again, it is India. Other aspect is, I think, all the geopolitical situation that we're talking about in Ukraine and Europe and all of that is also maybe helping India's case a lot more. We are seen as for example, Sri Lanka was touted as a nice place to start offshore, programs. Sri Lanka has its own story to talk about. The Far East Asia is also not they are focusing on maybe trying to take the mind share of what China is ceding as space. Europe is busy with their own gas issues, and I guess all of that. So India seems to be in a nice place with respect to being able to meet this demand. Even if the demand is slightly lesser, it's likely to get pointed towards India from a tech standpoint, is what I think. So you've got inflation helping us, you've got the geopolitical situation helping us. I don't want to say political stability in India, but overall, there is certain predictability in the chaos that we have in this country. People have got used to it. That's also helping the cost for IT. So, which is why you are seeing predictable IT spend happening, and which is the commentary which almost every other company has talked about.
Yeah, well, maybe India gains more market share. I mean, we are anyways the behemoths, but who knows? There could be more in store. Let's wait and watch. Yeah, it's an interesting point, both of you. Now, Venkat, the one word on supply challenges, and I want to know if you believe, who knows, it may get wrong, but as for you, is it now on a decline? Because when I was looking at the news flow of one or two IT companies withholding variable pay, and maybe for a quarter really, but if there was a scenario of extreme attrition, a company possibly can't even think of doing such a thing. The fact that a company actually did that, does it signal that the attrition woes are now starting to climb down? Or am I wrong?
Just from a data point, I would like to say that I think it was after the last quarter when I spoke to you, I said I'll stick my neck out and say that maybe things will get better in 2 quarters, but the jury is still out on it. But this variable pay point that's being brought out, I would just like to put something vis-a-vis Happiest Minds. We have committed to pay 100% variable pay, and we are sticking to that. No change on that front. So that's something that I would like to place on record. The other aspect of attrition, while I still stick to the point that things could get better, I would again request Joseph to add here, because he's suffering from the supply constraints. The demand is what he's responsible for, and also supply. So to that extent, I think Joseph would be the right person to add here.
Yeah, Joseph, but just that point from an industry-wide as well, you guys may be doing okay, but the fact that companies are able to take the move of holding back variable pay, even if for a quarter, does that signal that the attrition or supply side challenges are kind of ebbing?
So I think we just add, if I just add one point, I think they're trying to balance between margins and attrition, Neeraj. See, what happened is their margins have been hit. If you look at the last quarter results, everybody missed their guidance on margins. And that too, not by typical, 0.2%, 0.3%. They've all missed it by a large margin. So to that extent, I think the thought internally is we need to see how to juggle these two risks of margin versus attrition. And that's where I think some of these reports have emanated from. So that's from a financial standpoint.
Okay.
Yeah.
Joseph?
Just continuing, from where Venkat, from what Venkat was mentioning, Neeraj, and this is other companies. We don't have, we're not privy to what their thinking was. So it's more of rationalization, and probably we'll see a little bit more when this Q2 financials and results come out, because you'll get some color on what's happened internally. But my sense is that in the last year and a half, and again, what we've seen when competing in the market, right, for talent, I think some of the larger companies, they went out of their typical approach or bands or comp benefit approach that they would take, and especially in the middle management layer, because many of them had a lower percentage of digital, and they were seeing a lot of demand for digital initiatives and projects. And just to sort of make sure that these get started and get completed, I think they probably gotten more talent than they needed, or more people, and with the margin pressure and ran at a higher rate salaries, because with in some of the situations we were surprised at what some of the larger companies are willing to pay in some instances, which we've never seen in the past, right? Because they have their own salary bands, and the way they structure their compensation. And I suppose with margin pressure, as Venkat pointed out, and also looking at the demand environment, the little bit of risk, they may have taken a step back and said, hey, how do we really manage the situation and reduce our risk and cost out here? Is what I think has happened. It's not a reflection on the broader demand still. That's what I would say, Neeraj.
Okay. Yeah. The common joke was that.
But it's conjecture at the end of the day, because we don't know what is exactly happening in any of these companies. I can tell you, Venkat, I can tell you what's happening in Happiest Minds, but otherwise,
no, it's not industry-wide. If at all, this signals something. But yeah, I mean, I take on board the point. Fair call, gentlemen, both of you, thank you. But just one final question then. Since you brought up or evoked this $1 billion target, and you mentioned this 25% growth being organic completely, which leads me to question that if indeed there's an inorganic move that happens, if not in quarter 3, then quarter 4. Right?
Just a clarification. 25% growth. I'm not splitting it as organic, inorganic.
Yeah, but you mentioned that because there is nothing on the anvil right now.
Yeah, for FY23, FY23, we end up having to do it organically, is what I said.
Yeah. So if you do it organically, but in the remote chance, or in a chance, outside chance that something presents itself, then maybe the growth could exceed 25% as well in FY23, even if the consolidation is only for a quarter or a couple of quarters.
Yes, absolutely.
Couple of quarters out of the question, because but couple of quarters out of the question, because you're almost into end of.
A deal takes
it's
almost.
My job to try and evoke an answer. Which you don't give. So
I know. No, it takes about 6 months to cook a deal and close a deal, right? So even while I can try to do and eke out a quarter out of a deal,
it won't make a difference.
You're taking a part of my job. But yes, if I do that, yes, I'll give you credit for having forecasted it so well.
Well, the joke for the last 12 months, as gentlemen, has been that advise everybody else in any other industry but IT. So if I can take off a part of your job, Venkat, I'll be more happy to do
that. Agree.
But anyways, gentlemen, great talking to you. Thank you so much, and all the best for doing really well, not just for FY23, but for the course of the decade that you're speaking about.
Sure. Thank you, Neeraj.
Thank you very much, Neeraj. Always a pleasure speaking to you.
Likewise. Lovely talking to you.
Bye-bye.
Lovely.